I'm Sandeep from the Investor Relations team in Bangalore. Joining us today on this call is CEO and MD, Mr. Salil Parekh, CEO Mr. Praveen Rao, CFO Mr. M.D. Ranganath, President, and the other members of the senior management team. We'll start the call with some remarks on the performance of the company during the quarter by Mr. Parekh, followed by comments by Mr. Praveen Rao and Mr. Ranganath. Subsequent to this, we'll open up the call for questions. Please note that anything which we say which refers to our outlook for the future is a forward-looking statement, which must be read in conjunction with the risk that the company faces. A full statement and explanation of these risks is available in our filings with the SEC, which can be found on www.sec.gov. I'd now like to pass it on to Mr. Parekh.
Thank you, Sandeep. Sorry, I was on without the mic. And thank you for everyone to join the call. Good evening and good morning to everyone on the call. Thank you for joining us. I'm delighted to share with you our results. We had a strong quarter in Q2. Our growth in Q2 was broad-based across all business segments, geographies, and service lines. Our large deal wins were strong at over $2 billion, with over 60% net new. On a constant currency basis, our revenue growth quarter-on-quarter was a robust 4.2%. Our digital revenue growth was 13.5% quarter-on-quarter and 33.5% year-on-year. Our digital business is now 31% of our overall business. Within digital, we see strong demand, especially in cloud, IoT, cyber, and data and analytics. Our operating margin for Q2 was at 23.7%. Our financial services business grew well, 5.8% quarter-on-quarter, retail at 5.9%, manufacturing at 4.8%. Several of our sectors are growing over 10% year-on-year. In fact, financial services, we saw improving demand trends in the U.S. in Q2. We see strong growth in our business process management, cloud infrastructure services, and data and analytics service lines. Our large client growth was strong, with our largest 10 clients growing at 5% quarter-on-quarter, higher than the company overall. The demand environment looks stable across U.S., continental Europe, UK, and Australia. We are continuing our investments in agile, in digital, automation, artificial intelligence, and also in our people via training and compensation. Overall, we feel positive that our strategy of agile, digital, and automation and AI in core services is resonating well with our clients and building more relevance for us with them. The first step of our 3-year transformation program are being put in place and are starting to show traction. With this strong quarter, we remain on track for our guidance for constant currency growth of 6% to 8% for full year and operating margin guidance of 22% to 24%. With that, let me hand it over to Praveen for a few remarks.
Thank you, Salil. Good morning, everyone. As Salil said, we had a good quarter, both in terms of performance as well as deal wins. We had 12 large deal wins during the quarter with a TCV of $2.03 billion. 7 of the 12 deals were in Americas, 4 in Europe, and 1 in rest of the world. 3 deals each were in financial services and manufacturing vertical, 2 in high-tech vertical, and 1 each in retail, communications, and other vertical. Volume grew by 2.8%, and realization in constant currency terms also improved by 0.9% sequentially. Utilization excluding trainees was 85.6%. Attrition declined marginally to 19.9% on a standalone basis and 22.2% on a consolidated basis. We are taking specific measures to bring this down further. In Q2, we have added 19,721 professionals on a gross basis. Now let me comment on few of the business segments. Performance in financial services improved in line with our expectations as client-specific issues abated to a large extent. After declining for last 2-3 quarters, growth returned in top accounts in the Americas and spending was broad-based, helped by tax cuts and rising interest rates. Spending by U.S. banks is expected to continue for next few quarters. Clients continue to increase spend in digital, data, and cloud. Our proactive efforts have resulted in a large digital-led deal pipeline. While we expect momentum in the business over the next 2 quarters, driven by new account openings and expansion of accounts opened earlier, near-term growth will also be impacted by seasonality. Insurance continues to perform strong with robust deal pipeline, especially in RPA and BPM. The focus is on automation, data management, analytics, and BPM. In August 2018, Gartner published the Magic Quadrant for Life Insurance Policy Administrative System for North America, and Infosys was positioned as a leader, reconfirming our strong capabilities in this sector. We are seeing increasing strength in retail segment, primarily driven by our proactive pitches in digital areas and large deal constructs. Growth was led by CPG, transportation and logistics, consumer technologies, and lifestyle subsegments, while subsegments in retail continue to see structural shifts. There is increased focus on modernization, supply chain transformation, and optimization. Deal pipeline in the vertical remains strong. Communication segment has strong deal pipeline, which is broad-based across geographies. We expect near-term growth to remain strong due to recent deal wins, though Q3 will be impacted due to transition, lower working days, and furloughs. We are seeing investments around adoption and deployment of 5G, leading to advances in consumer IoT. We are working with clients and the industry forums to develop 5G use cases like network slicing that will reinforce the monetization of 5G networks. Manufacturing vertical reported sustained momentum, driven mainly by Europe and improvement in Americas. Automotive and industrial manufacturing in Europe and aerospace in Americas performed well. The deal pipeline is strong. We command a strong position in the automotive space in Europe, and acquisition of Fluido, Brilliant Basics, and Wong Doody will further solidify our presence as we gradually integrate their expertise with our overall offerings. Energy, utilities, resources, and services sector continues to grow strongly on the back of continued momentum in client accounts and ramp-up of previous wins. Stable oil price is working as a tailwind for players across the value chain in the energy segment. In the utility space, enhanced information system to drive personalized customer services, investment on smart grid, automation for safety, and sustainability are the focus areas. Outsourcing is a key theme in the resources sector to attain cost savings. Overall, we are seeing healthy growth in our deal pipeline. BPM is achieving industry-leading organic growth and margins. It's stalled deal pipeline, both in traditional as well as digital and platform-based offerings. We are seeing increasing demand across the major geographies, some sectors like high-tech, insurance, healthcare, etc. Mechanics continues to be a good growth opportunity for us. Finally, digital adoption continues to expand across verticals and geographies, and we are seeing tremendous growth in this area. We are seeing more and more discretionary spend being focused on digital technologies. We continue to invest to further enhance capabilities and customer relationships, and acquisition of Fluido will further enhance our footprint in digital in newer geographies. Our digital strategists bring capabilities across digital domains and takes lead on all digital transformation engagement. The deal pipeline in digital space looks healthy with a good mix of large deals. I will pass on to Ranga to give some color on the financials.
Thanks, Salil and Praveen. Hello, everyone. Welcome to the Q2 earnings call. We had a strong performance in Q2. Several key financial metrics and operational metrics saw multi-year high during the quarter. Revenue growth, deal wins, digital share, top line growth, cash generation, and margins saw good trajectory during the quarter. Salil and Praveen have already talked about the revenue metrics, client metrics, and business outlook. Let me start with a few outcomes during the quarter. First, on a first half-year over half-year basis, our revenues grew 6.9% in dollar terms and 7.1% in constant currency terms. In rupee terms, the H1 growth was 14.7% over the last year H1. Second, our EPS in dollar terms grew sequentially in Q2 by 8.8% and year-on-year by 5.7%. After normalizing for Panaya charge that we took in Q1, sequential EPS growth in Q2 works out to 1.4%. In rupee terms, EPS growth in Q2 as compared to Q2 of last year was 16%. Third, our operating margin for the quarter was steady at 23.7% at the higher end of margin guidance of 22 to 24%. I will provide more color on this shortly. Fourth, our return on equity ROE was healthy at 24.7% and increased from 21.2% in Q2 of last year, an increase of 3.5% over 1 year. Fifth, our relentless focus on operational efficiency parameters continued this quarter. Utilization excluding trainees continued to be high at 85.6%. On-site mix, which I have been talking about for the last few quarters, further moderated to 28.4%, which is one of the lowest we have seen in several years. Due to continued productivity improvements, stable utilization, and increase in digital share, revenue per employee increased by 3.8% year-on-year to $54,663. Sixth, free cash flow was at $360 million for the half, and for the half year, the free cash flow was $912 million. In H1 of 99, we had higher tax payments due to APA that was concluded earlier in the year, and lower other income due to the share buyback, which we concluded of $2 billion in December 2017 as compared to H1 18. Now let me come to revenues, price realization, and margins. Revenues in Q2 19 were $2,921 million, a sequential growth of 3.2% in dollar terms and 4.2% in constant currency terms. In rupee terms, the revenue for the quarter was 20,609 crores. This is a sequential growth of 7.7%. As compared to Q2 of last year, revenues grew 7.1% in dollar terms, 8.1% in constant currency terms, and 17.3% in rupee terms. Price realization in Q2 in constant currency terms was stable on year-on-year basis and improved by almost 1% in constant currency terms on a quarter-on-quarter basis. We do believe that year-on-year change in price is a better indicator. Blended volume growth in Q2 was 2.8% on a quarter-over-quarter basis. In first half year, H1, our blended volume growth stood at 7.8% as against the constant currency growth of 7.1%. However, our focus on optimizing on-site employee cost, including sharper focus on productivity, on-site pyramid, localization, and optimization measures, led to a decrease in the on-site employee cost as a percentage of revenue to 37.4% in Q2 as compared to 37.9% previous quarter. This is one of the lowest we have seen in several years. However, our subcontractor expenses as a percentage of revenue increased to 7.4% of revenue in Q2 as compared to 6.8% in the last quarter and 6.2% in Q2 of last year, which is an increase of 1.2% year-on-year. During Q2, we made further investments in expanding our localization initiatives and other areas that we had outlined at the beginning of the year. These investments will continue till rest of the year as we had outlined in the beginning of the year. Operating margin in Q2 was 23.7%, same as last quarter. During the quarter, rupee depreciation, net of cross-currency, provided a benefit of 80 basis points. Improvement in operating parameters, including higher pricing, and lower on-site mix, which I talked about, and to some extent even lower visa cost, helped the margins sequentially by another 70 basis points. This aggregate benefit of 150 basis points was offset by compensation increases and higher variable pay amounting to 100 basis points and certain interventions that we took to address the attrition. Further, increase in subcontractor costs, on-site localization, and investments impacted the margins by 50 basis points. So overall, operating margins remained flat sequentially. We ended the quarter with a total headcount of 217,739 employees, which is an increase of 3.7% from last quarter. Gross headcount addition increased to 19,721. We had 11,887 employee quits during the quarter as compared to 11,911 quits last quarter. We continue to focus on measures to mitigate attrition. Cash generated from operating activities in Q2 as per IFRS consolidated was $438 million, which was after the $76 million of taxes paid as per the APA entered with the United States IRS earlier in 2018. Capital expenditure for the quarter was $78 million, which is approximately 554 crores. Cash and cash equivalents, including investments, to debt $4,185 million, which converts to approximately 30,366 crore rupees. Debtor days outstanding for the quarter stood at 66 days due to superior working capital management. Q2 continued to witness huge volatility in currency market, and we managed to navigate the same effectively. Yield on cash for the quarter was 7.53% as compared to 7.2% last quarter. Hedge position as on September 30th was $1,966 million. The company today announced an interim dividend of ₹7, approximately 10 cents per ADS, as compared to an interim dividend of 6.5 rupees per share after a bonus share adjustment announced same quarter last year. This is in line with the capital allocation policy as articulated earlier in the year. We plan to make further investments as we outlined in the beginning of the year on employee front to address attrition in the coming months towards residual salary increases for title holders and targeted increases for some part of our workforce. Coming to operating margin guidance for fiscal 19, we are retaining our operating margin in the guidance range of 22 to 24%. Coming to revenue guidance in constant currency terms, we continue to retain 68% based on March 31st, 2018 rates. Lastly, I would like to thank each one of you in the investor community for the wholehearted support that I received over the last 3 years in my role as CFO of this iconic company. During the last 3 years, the company delivered a strong and resilient financial and operational performance on multiple fronts. Free cash flow, return on equity, growth in digital, execution of capital allocation policy, and significant improvements in productivity parameters like per capita revenue and utilization. Between fiscal 2015 and 18, while the revenue increased by 26% in dollar terms, the free cash flow expanded by 40%, utilization touched high levels of over 85%, and return on equity improved, and we executed capital allocation policy with a share buyback of $2 billion. Unwavering focus of the entire management team made these outcomes possible. I'm happy that the company's financial performance is strong and resilient as I pass the baton to my successor. Thank you very much for your support all these years, and we will open the floor for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Moshe Katri from Wedbush Securities. Please go ahead.
Hey, thanks. Appreciate letting me ask a question here, and congratulations on strong execution. Just going back to the commentary on margin trends, so obviously there are some investments that are going on. You mentioned subcontractor use, and I think there's also variable comp that went up. What makes us comfortable that we can sustain the margin range that we got it for? That's number one. And then from a big picture perspective, is there any color in terms of what enterprise clients are saying regarding their comfort about IT spending initiatives, given the the volatile political uncertainty out there? Thanks a lot.
Hey, Moshe, Ranga here. Thanks for the question. First, we are comfortable with the margin guidance of 22 to 24. If you look at the first half of the year, we ended at 23.7%, pretty much at the higher end of the guidance. And as I said earlier, for this quarter, sequentially, the margin was steady at 23.7 in spite of the rupee depreciation, because as I said, some part of it went into the compensation hikes for the middle to senior level, and to some extent in higher subcontractor expenses, as I said. Coming to the subcontractor expenses, we have to see in the broader context of the talent supply chain for the U.S., especially for the digital areas where we need certain niche skills at short notice due to the visa and other regime, certain timelines. We have to go for the higher subcontractor without to ensure that we are not leaving the business on the table. At the same time, we are also looking at seeing how to moderate this in a meaningful manner. So overall, I think coming to the investments that you talked about, we had planned certain investments to leverage digital opportunities, localization at the beginning of the year, and we had also said that the trajectory of these investments are more towards the H2 than H1, because some of them are hiring related, some of them are investments that has a cycle time to realize. So in the H2, we expect a higher investment trajectory. So these are combination of factors which are really into the overall margin perspective. But we are quite comfortable with the margin guidance we have given, and first quarter has been pretty much at the top end of the guidance.
Moshe, this is Praveen here. I just wanted to address your query on the spend. If you look at our performance this quarter, we have seen spend broad-based across verticals and geographies. We saw 4% constant currency growth in Europe, North America 3.8%, and spend has come back in North America after a few quarters. Rest of the world, we grew 6.8% on constant currency. And even when you look at it from a vertical perspective, we had good growth in financial services, retail and CPG, as well as manufacturing. We had moderate growth in Sure and high tech. We saw some softness in communication and life sciences and healthcare. But looking forward, given the demand environment, the pipeline that we have, we feel fairly comfortable with almost all the verticals and geography-wise as well. The spend is there. Obviously, we have to keep in mind the seasonality. Quarter 3 is typically a soft quarter, given the higher number of furloughs and lower working days. That's something we need to wait and watch out for. But barring that, barring life sciences and healthcare where we see some softness, we expect good momentum in the coming quarters across all other verticals, both in Americas as well as in Europe.
Much appreciated. Thank you.
Thank you. The next question is from the line of Yogesh Agarwal from HSBC. Please go ahead.
Yeah, hi. I have a couple of questions, if I may. But before that, Ranga, all the best for your future endeavors. My best wishes. Firstly, Praveen, I wanted to ask on U.S. banks. You mentioned that the next few quarters you will see ramp-up of existing deals plus the new ones, but there will be seasonality hit as well. So, but net of everything, you still think seasonally versus the previous year's seasonality will still be better because of the new deal wins, is it?
This is Mohit Yogesh. No, I think, look, the seasonality trend is the same as the previous year. You will see some furloughs, some end-of-year, budget pressures. But equally, we've seen very strong momentum in this quarter. And we retain our main thesis, right, that we're in a strong position in this sector. I think the performance numbers for this quarter speak for themselves. And, you will see headwinds in any quarter and tailwinds, but overall, it should be the same as the previous year. And we remain, medium to long term, very positive about the sector and our own strength in the sector.
Right. Okay. And just generally, I wanted to ask on digital pricing. Most of the large clients will be governed by a big MSA, whereas digital pricing has to be higher, as you guys have mentioned in the past. So most of these deals are not coming in MSA and you price them separately? And if not, how do you price it higher than an average deal pricing?
Yeah, so this is Ravi here. The digital services, if you've seen our strategy and the Pentagon, it falls in those 5 pillars. A lot of this spend in the market in terms of maturity is in cloud infra, strategic cloud applications, modernization, API microservices, which is the accelerate pillar of the Pentagon. So that's where a lot of spend is. It's kind of attached to the legacy world, but it kind of then, you're migrating from the legacy world to the new world as you migrate workloads into the cloud and as you take legacy cloud applications into on-premise applications into the cloud. So we kind of attach ourselves with the current master services agreements, but we also have an opportunity to carve them out as new services and ask for a premium. But as these services progress in terms of more momentum into areas of experience, insights, innovate, and assure, the other 4 pillars, I would actually think you could carve them out separately and run it. But at this point of time, we're kind of continuing with existing rate cards and then using wherever we have an opportunity to change the master services agreements.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Sandeep Shah from CGS-CIMB. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a good execution. Just looking at the order book, Salil, can you give some color that the improvement is because of more internal factors led by the internal restructuring to pursue the large deals, or is it more to do with the improvement in market conditions and the demand conditions? And second, do you believe looking at the pipeline now comfortably crossing 1 billion is a new normal going forward for you? And this quarter, what is the average tenure of the deals?
On the way this was put together, I think clearly the market is in a good shape. As we shared earlier, our view is the demand environment is quite strong across many of our large sectors. We see good demand across all the geographies. We see a stable demand. So that is part of it. Part of it is the way we are now intensely focusing on what our clients need and putting together a real execution element to what the large deals group creation was some time ago. So it's a combination of both of those things from what we see. In terms of the size of the large deals, I think these are lumpy deals, as I'm sure you see. It's difficult to have, in that sense, defined target each quarter. We look for this over a rolling 4, 6, 8 quarter basis. Having said that, our demand pipeline today is quite strong and robust. So we feel quite comfortable that the demand environment also for large deals is strong. But it's difficult to be specific about what will be the size of that each quarter. It will be up and down. In terms of the tenure, we don't disclose it in terms of the overall tenure. But I know some of the larger deals will have a fairly short tenure. So we look forward to having this support outlook in terms of revenue in the coming quarters.
Okay. Just to follow up, for the second half, if I look into the implied guidance, at the lower end, we are indicating a decline on a compounded Q-on-Q basis for the next 2 quarters. This is despite a strong commentary for a majority of industry segment as well as strong order book. So, and plus some inorganic acquisitions coming in. So why not upgrade just the lower end of the guidance?
Our view is the demand environment is strong. We've set our guidance at the start of the year. Our execution remains something we are happy with. And in that regard, we are comfortable where we are with respect to where we've landed in H1. And we continue to see good traction that we will land in that sort of a range as we look at the full year. But we've decided not to make any changes in terms of the band.
Okay. Thanks and all the best. And all the best, Ranga.
Thank you.
Thank you very much.
The next question is from the line of Joseph Ferrezi from Qtr. Please go ahead.
Hi. So my first question is, do you think you'll expect in the future to trade off margins for investments? Do you think that's going to happen long term? And what's the cadence for the margin profile in the second half of the year?
Hi, Joe. Hi, Ranga here. I think, as I was saying earlier, the first half of the year, our margin has been at 23.7%, pretty much at the top end of the guidance. And, though we had certain rupee benefits, we also had certain additional investments in compensation and also in some of the localization pieces. I think coming back to, and also, of course, our trajectory for investments in the second half is likely to be higher than in the first half, as we had outlined in the beginning of the year. But overall, I think we are comfortable with the margin band that we have given. At the same time, we are also looking at some of the subcontractor expenses moderation and some of the other items that we need to look at. Overall, I think we are comfortable, and it is not due to any lumpy costs or lumpy investments. It's pretty much on the lines that we had planned.
Okay. But I guess, and I just have one other question after this, but how do you feel about that margin profile over the long term? I mean, you've got digital growing at a nice pace for you. It seems like investments are necessary. You're looking at M&A. Do you think that if we roll forward past this year, will that 22 to 24 band be something that you're comfortable with, or do you feel like you'll be trading off, investments for margins over the long term?
I think the way we are looking at our margin plays on two twin axes. The first axis is the digital itself. As we have been consistently been saying, our digital price points are better, and more importantly, our digital gross margins are certainly higher than the core IT by a couple of percentage points. And so as the digital share increases, that is one play that we have on the margin. The second part is on the core IT services. The focus is really on the productivity improvements through automation, productivity, as well as the on-site cost optimization by way of the on-site pyramid with the localization and the fresh hiring that we have started. These are some of the pieces that we continue to seek for. It is a twin play between the margin expansion in the digital part, which we have seen, as well as the, not the margin expansion, but the higher margin profile in the digital that we have seen, as well as the productivity-led margin improvements in the core IT. So I think in the medium term, we are comfortable in the current range of 22 to 24.
Got it. Okay. And then the last question, can you frame for us your exposure to the European banks and maybe your expectations for their performance in the second half of the year and how that fits into your overall financial services commentary? Thanks.
Sure. So this is Mohit here. I think, look, for this quarter, we had a steady performance across the world. So whether it is in Europe or in, the Asia-Pacific region or the U.S., we saw strong performance. Obviously, our performance in the U.S. was the strongest. Having said that, we do have a large exposure to European banks, and we feel very comfortable about our growth prospects there. Obviously, there is some concern around volatility around what may happen with Brexit. But as of now, we have a very strong competitive position among our banking clients in Europe, and we feel very comfortable with the growth trajectory that we see there, which is in line with what we see across the world.
Thank you.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I just had one question around the margins. Ranga, if you may help me. So the couple of maybe areas which are offsetting the impact from currency, you sounded off multiple times, being some of the interventions due to the high attrition, comp hikes, etc., and also the strategic investments for the year. So just wanted to get some more color on the nature of continuity for these. Would you think that maybe the interventions-related cost would roll off by the end of the year or may continue into the future, into FY20 as well, in order to contain attrition? And even on the investments front, while the trajectory would be maybe skewed towards the second half, do you expect it to maybe cool off and you will be fairly invested going into the next fiscal?
Hey, Ashish, this is Ranga here. I think, as we said earlier, especially this quarter, the 100 basis points on account of the compensation and the specific interventions I talked about. On the compensation part, as we had said in Q1, 85% of the employees had got comp increases in Q1, and for the balance 15, we had certain increases commencing July. That's one point. And the second one, these interventions that we had to make were by way of higher promotions in certain cases, as well as certain comp increases as well. So we do not, while we continue to focus on how the attrition trajectory moves, we do not expect, on an ongoing basis over multiple quarters, we do not expect that. Second, on the investment trajectory, we clearly had outlined in the beginning of the year. Specifically, if you recollect, we had brought down the margin guidance band by 1% in the beginning of the year. That trajectory is something that we are investing in. And first half was we started to make those investments, whether it's in localization or the sales, as well as the digital investments. And I had said earlier, the trajectory will be sharper in the second half as compared to first half. And at this point in time, beyond fiscal 19, these investment piece at this juncture, we do not see beyond what we had anticipated at the beginning of the year.
Got it. That's helpful, Ranga. That's it from my side, and wish you all the very best.
Thank you. The next question is from the line of Surendra Goyal from Citigroup. Please go ahead.
Yeah, hi. Just had a couple of questions here. Firstly, Ranga, I'm looking at gross margins YOY. 90 bips down despite 10% INR move realized rates. And this despite cross currencies would definitely have been a tailwind. And I think, as you said earlier and as well as on TV, that digital has better gross margins. And all the growth YOY seems to be coming from there. So can you please help us reconcile, because the quantum still seems to be quite big and yet margins are down 90 bips YOY.
Well, I think, let me give the YOY reconciliation on the margins. Two factors, as you rightly pointed out, are the currency expansion between YOY, etc. Now, if you look at the cross-currency on a YOY, I'm talking about the quarter-over-quarter, rupee impact was a positive of 2.2%, and cross-currency had another 0.1 positive, so the total was 2.3%, overall positive. The comp review that we executed in Q1, which is kind of flowing through to Q2, had a 2.3% negative, so entirely negative. Additionally, we had a 10 basis point additional impact because of the higher variable pay, 95% in Q2 as compared to earlier years. Then certain operational, so essentially that negated the entire rupee and cross-currency impact, net-net. So beyond that, we had certain positive impact on the margins on account of higher utilizations to 40 basis points, on-site mix 30 basis points, which entirely was negated by the higher subcon expenses that we had. So net-net, I think if you knock off the rupee and cross-currency by higher comp review and variable pay, that essentially negated that. So any improvement in operational parameters was taken by additional subcon and certain other expenses. So net-net, the net decline was 0.5%. So that's the broad reconciliation.
Sure. And is it possible to quantify the investments that you have been talking about? Because while you keep on saying that margins are in line with the guidance, but when the guidance was provided, the currency levels were very different. So I just wanted to understand if there is a way to quantify the investments.
Well, I think especially the sales investments you can pretty much see in our financials in the employee cost piece that is clearly visible. And some of these investments are also in localization that we talked about. There are some of our CapEx which will result into some additional depreciation as well as some of the OpEx that we did. And also I would like to say that some of the digital areas where we had certain hiring that we did will also reflect in the employee cost. At this point in time, even in the beginning of the year, we have not really quantified this amount, but what we can say is that the overall 1% reduction that we talked in the beginning of the year fairly reflects 1% in the guidance, fairly reflects the quantum. Roughly, I think the second half would be much more, the trajectory in the second half would be sharper for those investments.
So, Ranga, let me ask that question a little differently. Have investments that you had planned for, have they gone up? Because the currency move is quite sharp, and despite that, you are maintaining the margin band. So I'm just trying to understand if the investments that you planned have actually gone up compared to where they were when you had guided for the full year.
No, that's not the case. I would say that the total quantum that we have anticipated has not moved up, but the trajectory and the pattern of those investments probably are more in the second half. That's the way we see it. The trajectory is much more intense in the second half.
Sure. And just one last question for Praveen. Praveen, you said in your opening remarks that Q3, and again I'm talking of communications here, that Q3 will be impacted by transition as one of the factors. And looking at the press reports, it does seem like the large deal has a lot of rebadging, etc. And our understanding was that revenue should start coming in as soon as the transition kind of goes through. So is it that the transition will take long enough that the revenues will start kicking in only in Q4? Is that a correct understanding?
Yeah, we have had 12 large deal wins when you look at the 2 billion breakup. In some of the wins, you do have some element of rebadging. In many other cases, you may not have much of rebadging. It's a combination of things. So our experience is whenever we win large deals, it takes a period of time before revenue starts kicking in, post-transition and so on. So we would expect, while we have had 2 billion plus of TCV win, some of it will start reflecting in our numbers only subsequently. So that is what I meant when I said there will be a transition impact as well. But apart from that, you have the regular seasonality in Q3 of lower working days and furloughs.
Sure. My question was specific to communications, but that does answer my question. Thank you.
Thank you. The next question is from the line of Viju George from JP Morgan. Please go ahead.
Yes, thank you for giving me an opportunity. I just wanted to dig a little bit deep into the cost. I think there are a host of factors that you've cited. What are the elements of the cost? I mean, you've talked about subcontracting, about sales. There have also been higher compensation, promotions, variable pay, etc., etc. What are the elements of cost that you feel may be non-repeating as we go forward?
Hi, Viju. This is Ranga here. See, I think the investments costs are pretty much we had outlined, and we are pretty much seeing the same trajectory, nothing, outside the trajectory. We had kind of said that in the second half, the trajectory will be intense. And the compensation, that 100 basis points that I talked about, the part of it was compensation, the 15% of the employees, which was really planned for the Q2 as well. I think these two were there. And the subcontractor expenses going up is something which is clearly the demand and supply chain matching related. That is something which we are looking at to see how best to optimize that. So these are the two critical elements for Q2.
Yeah, so are there any elements that you think, Ranga, therefore taking this forward, are there any elements that you think will not repeat in the sense some of the payouts in order to rein in attrition? Is that something that you expect has largely been done and therefore may not sustain? Because I'm just trying to understand what are the elements, besides your investments, that anyway you said will be skewed in H2, among the other variables would probably not repeat to the same extent. For instance, is it logical to assume that because Q3 will be a slower quarter, variable pay may not be that high, likewise the subcontracting may not be that high. So maybe those costs should moderate, logically speaking.
Well, I think I don't want to kind of see, the subcontractor piece is, as you know, it's really the short-term measures we have to undertake primarily to meet certain specific on-site demand, which otherwise, through our employee base, we are not able to fulfill. And so that is, in the short term, it is difficult to predict that, but at the same time, now that it is just 7.4% from 6.2% last quarter, we are also seeing certain, if you look at the headcount addition that we saw this quarter, both on-site and offshore has been broadly in line with our plan. So these are some of the two factors that will really play into this subcontractor. One is to what extent we could staff with our own employees. So at this point in time, we are fine with the current levels, and we will see how the next 2 quarters play out.
Sure. And when you step back and look at the start of the year and look at how the cost picture has panned out, except for the costs that you've incurred in connection with reining in attrition, and therefore the payouts you've incurred in this quarter as that, would you say that most of the other elements have been as per track, nothing has been unexpected?
Well, I don't think so, because as I said, clearly not. If the question is, are there any unforeseen costs that we had to encounter, that's clearly not the case. The subcontractor piece I talked about and some of the interventions on the attrition that we talked about, even for the second half, the investments have been planned out, and these are all pretty much that we see at this point in time. It is not that certain unforeseen costs that happened here and that really kind of brought down our the positive impact of the rupee during the quarter. That's not the case.
Sure. And Mohit, one question here on financial services, if I may, please. I think the same time last year, you had also indicated optimism, basically premised then on, possibly the interest rates will rise in the U.S. and interest rates are rising right now. And today you've got growth in, and it looks like you've got a far better order book this time than last year. So do you think that therefore there are more concrete data points to suggest that this may not be a false alarm, and therefore this momentum would sustain for in a more certain manner?
I agree. So, Viju, I think, look, last year, at the end of Q2, we had a couple of other internal issues, that you know about, apart from, client and industry-specific issues. This time around, based on the results that we've seen from the banks, based on the trajectory of the, the yield curve, not just in the U.S., but across the world, it certainly seems to be, more sustainable. We're also saying, there are two broad spend areas, right? First is we are continuing our, traditional dominance of, of consolidation of the run part of the business, where clients are still looking to focus on reducing the cost-income ratio. So that continues to be a traditional area of strength. The other piece is on the digital piece, right? Where increasingly we are seeing a demand from clients asking us to come and bid for business to build new digital platforms in trade, in payments, in lending. There does seem to be a perspective that banks are looking to expand, after a long time, right? Pretty much after the global financial crisis, banks are looking to expand their animal spirits into that. Having said that, our view always has been, sort of more medium and long term. From a quarter-to-quarter basis, we will always see, headwinds and tailwinds. But in the long run, we remain optimistic about, the state of the business.
Sure. Can I push in one more question for Salil? Salil, as an industry, there are lots of cost pressures in the system today. Your H-1B visas are tough to come by. Localization costs have moved up. I think the wage inflation in the U.S. is hot, so the market for software services is red hot right now. So clearly as an industry, pricing will have to be passed on to clients. Subcontracting does not help. Do you think as an industry, we are ready to sort of have that conversation with clients saying that input costs are increasing and therefore it's time you start to sort of have conversations on price increases? Is that happening? At an industry level or the player-specific level? Or is it purely driven by mix still?
Right. First, I think if you look at our data, pricing is stable from previous quarter, which already is a good sign. In general, I think there are elements around digital where there is an ability to demonstrate more and more value. If we can do that across the sector, then there is possibility of what you're describing. In other places, there is a huge benefit if you can apply more and more automation and artificial intelligence. That can give us some benefit of holding pricing while having some impacts on margin. And as Ranga described earlier, there is other parameters which I think we can look at internally as we go through the rest of this year and into the next year, which can help us to make sure that our margin profile remains stable or even sometimes find ways to get that expanding.
Sure. Thank you. Ranga, all the best.
Thank you.
Thank you very much, Vijay.
The next question is from the line of Ankur Rudra from CLSA. Please go ahead.
Hi, thanks. Could you to start with comment on add color to the substantially higher deal wins you've had this quarter, and if there is any change or departure from previous margin or asset intensity thresholds for the nature of deals you signed this time?
Ankur, can you repeat the question?
Yeah, I just wanted to get some more color on the deal win, the order book this time, and if there was any departure on previous margin and asset intensity thresholds.
Ankur, this is Praveen here. As we said, we had 12 large deal wins, 7 in Americas, 4 in Europe, and 1 rest of the world. Big percentage of deals were in financial services, manufacturing, and a couple of them in high-tech, 1 each in the retail, and etc. Overall, we have not seen any significant change in the intensity or the competitiveness of this deal. All these deals, we have faced global competition before winning the deals. And as we have done in the recent past, we continue to be aggressive on winning large deals and executing on our margin improvements, leveraging some of the investments we are making on tools, technologies, automation, AI, and so on. And to some extent, if you look at last 2 quarters as well, if you look at from a pricing perspective, realization perspective, it has been fairly flat on a year-on-year basis. So to that extent, I think our strategy of going aggressive and winning the deals and trying to execute on superior execution and meeting our margin requirements has stood out so far. Net, we don't see any change in the pattern, any dramatic change, or we have not seen any significant change. In this space, it will be a competitive, it continues to be a very competitive space. Clients continue to look for cost takeout so that they can repurpose their saving in other areas, and that trend will continue.
Sure, thanks. Also, earlier in the call, Praveen, I think you commented that spending looks maybe in financial services, look strong for the next few quarters, you seem to stop short of giving a more structural view on financial services spending. Is there something that limits your visibility right now, to limit your comments just for the next 2 or 3 quarters, given a very strong order book and good momentum?
Ankur, this is Mohit here. So look, I think what Praveen is trying to say is that we've obviously had a strong quarter. We had good deal activity. We had strong volume momentum. But with the caveat that Q3 is a seasonally weaker quarter. There are furloughs. There are some clients who have end of the year budget pressure. So we just wanted to give that qualification. We remain very confident about the overall state of the sector and our competitive positioning. The qualification is the fact that if you go back previous many years, there is a seasonal trend in the business.
Sure, but beyond the seasonality, which would show up perhaps in Q3, maybe in Q4, there is nothing else structurally which makes you less comfortable about demand environment beyond these 2 quarters.
We remain very confident about the state of the industry in terms of spend, and we remain very comfortable about our competitive positioning.
Okay, thanks. Just one last question on the cost. I know it's been discussed a lot, but was the incremental subcontracting cost, perhaps despite the offshore shift, something that was a bit unexpected from what you thought would happen over the course of this year? Is there something on the supply side that worries you and probably is causing greater than expected cost inflation?
Yeah, Ankur, Ranga here. I think, as I was saying, the subcontract costs are very much on site to meet the demand, which otherwise we couldn't really, staff from internal sources. It's a play on both the gross addition as well as the attrition, and the both play a role. And so this time, I think on the on-site, those requirements came because of these elements, and that's why it is 7.4. And we have had some good gross additions, rather net additions on-site this quarter, which should play into the next quarter. So we're closely monitoring that. So, but we expect at the current levels no substantial reduction.
Okay, thanks for that, best of luck.
Thank you. The next question is from the line of Brian Bergen from Cowen. Please go ahead.
Hi, thank you. I have 2 for you. First, can you tell us what the assumed contribution from inorganic growth is in the full year growth range?
Very negligible.
Okay, and then on margin, can you give us a sense of the level of benefit to operating margin that you've seen from automation initiatives that you've implemented thus far? And then on the subcontractors, should we be thinking about, as you go through the 3-year transformation plan, a new structural range, so to speak, as far as the level of subcontractor expenses?
Well, I think, we used to have in the close to 7% several quarters ago, and it got moderated to, early 5%. I think at the same time, during the last 12 months or so, we also seen certain visa regime changes in the United States that has put certain lead times for the visas. And while we have accelerated the localization and local hiring, and still we need to meet certain immediate project requirements, especially in digital and niche areas. So that is the reason we have had, and we also had certain elevated level of attrition on site. So a combination of these 2 factors has led to an incremental uptick in the subcontractor to 7.4%. And nevertheless, I think as we have seen certain net addition improving during Q2, which will play into Q3, we are closely monitoring that. Having said that, in the near 1 or 2 quarters, we don't see significant change from the current levels.
Brian Bergen, are you done with your questions?
Yes, thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you very much.